Did you know that some of the world's most legendary traders, people like Warren Buffett, didn't just buy shares outright? Instead, they used something called a cash-secured put to get into their positions. Believe it or not, this tweak can save you thousands of dollars and give you an edge that most rookie investors completely miss. Today, I'm going to show you exactly why these legends chose this method and how you can do it too. Stick around because once you understand the strategy, you may never buy shares the old way again. Let me take you back to my early trading days. I'll never forget the time I saved up enough money to buy my very first 100 shares of Apple stock. I was so excited, I hit that buy button with pride. Then not even 2 weeks later, the stock dipped. Suddenly, I was staring at a paper loss, wishing I could have bought those shares at a lower price. A friend of mine, who happened to be an options trader, called me and said, "You know, you could have sold a cash-secured put instead and collected a premium in the process, right?" That conversation changed the way I trade till this day. So why do legendary traders do this? Because cash-secured puts can reduce your cost basis, generate immediate income, and force you to buy shares at a price you actually want. This is how the pros do it, and it's a big reason why Warren Buffett himself has used cash-secured puts on stocks like Coca-Cola and Wells Fargo for years. So why bother with a cash-secured put instead of a straight-up share purchase? Number one, lower cost basis. If you were going to buy shares at $50 anyway, wouldn't it be great to potentially buy them at $47 and get paid for waiting? Number two, premium income. When you sell a put, you get paid a premium up front. If the option never gets exercised, you just keep the premium. And then number three, flexibility and control. You pick the strike price, the expiration, and the underlying stock. You're not at the mercy of buying at whatever price the market price is at that moment. And if you're new to this idea, this might sound almost too good to be true. But legendary traders, including some big hedge fund managers, rely on this approach to get into positions on their own terms. They'd rather earn money while waiting than passively watch from the sidelines. Now, before you dive in, let's bust a few common traps that wreck new traders who try cash-secured puts. Number one, selling puts on risky stocks. Some people see a huge premium on a speculative stock and get excited, but if the company is fundamentally weak, you might end up stuck with shares that you really don't want at a price that's still too high. Number two, forgetting to keep cash secured. The cash secured part is vital. Make sure you have enough cash in your account to buy the shares if you get assigned. Trading on margin without fully understanding the risks can get really ugly. And then number three, picking the wrong strike and expiration. Some new traders pick a strike price that's barely out of the money or too far out of the money without a plan. You want a strike price that reflects a realistic discount you'd love to buy the shares at, paired with an expiration that aligns with your investment horizon. If you fall into any of these traps, your foray into cash-secured puts could turn into a nightmare very quickly, okay? So let's steer clear. Here's a quick true story that blew my mind. In the early 1990s, Warren Buffett reportedly sold cash-secured put options on Coca-Cola. At the time, he was perfectly happy to buy more shares if the stock price dipped to his strike. If it didn't dip, guess what? He pocketed the premium. Eventually, he ended up acquiring a massive stake in Coca-Cola at a price he loved, while also collecting millions in premium along the way. That's a masterclass on how legendary traders think. Always find a way to benefit, whether the stock falls or not. So, how do you replicate that approach? Here's my simple step-by-step method. Number one, pick a stock you love. Make sure it's a company you genuinely want to own. Legendary traders don't just throw darts, they do their research. So if you'd be excited to hold these shares for a year or more, it's a good candidate. Number two, decide on a target price. Ask yourself this one question. At what price would I be ecstatic to buy these shares? That becomes your strike price. Example, if a stock trades at $50, maybe you'd be thrilled to own it at $45. So that's your potential strike. Number three, check the options chain. Look at puts that are slightly out of the money or at the money if you're more aggressive. I like selling cash-secured puts that have a delta between 20 and 30. Then choose an expiration date that matches your time horizon. Maybe 30 to 45 days if you're comfortable rolling or reevaluating every month. Number four, collect your premium. Once you sell that put, you receive a premium instantly into your account. This is like the instant discount. The key here is have the cash ready in your account to cover if you're assigned, and then assignment or expiration. If your stock stays above your strike price by expiration, the put expires worthless, you keep the premium, and you can repeat it. If the stock dips below your strike, you'll be assigned the shares at the strike price that you wanted, which is already a discount to the original market price. Plus, you still get to keep the premium. So boom, you're now in a position, but at a lower cost basis than if you had just clicked buy. Let me just reiterate the big aha moment. When you sell a cash secured put, you're basically telling the market, I'm happy to buy these shares at the strike price that I chose. If it gets there, great. I was planning to buy them anyway, and I get them at a discount. If it doesn't get there, fine. I just got paid for my patience. And that's the exact kind of thinking that sets legendary traders apart. They're not in a hurry to chase stock prices. They let the market come to them. They set a limit, collect their premium, and wait. Meanwhile, impatient traders are out there buying at full price without any premium cushion. Over years and decades, that difference is huge. I do this all the time, and it creates a great monthly passive income for me while I wait for certain stocks to get to a price I want to buy them at. Now, a few quick questions you might be asking. 1, what if the stock crashes way below my strike price? Well, that's the risk you signed up for. You buy shares at your strike. However, you'd have been willing to buy them at that price anyway, right? Plus, you get a premium to offset some of that dip. If it dips more, that's an inherent risk of being a shareholder. 2, do I need to have a huge account to do this? Technically, you only need enough money to cover 100 shares at your chosen strike. That can be big or small depending on the stock. Some folks start with cheaper stocks or ETFs to get the hang of it. For example, American Airlines is currently trading around $18 per share. If you wanted to sell a cash secured put to pick up American Airlines shares at $16, you would need $1,600 in cash to cover the 100 shares, right? So good enough for a smaller account. Costco, on the other hand, is trading at around $930 per share. So if you wanted to pick up Costco shares at, say, $900 a share, you'd need to have $90,000 to cover the purchase of 100 shares. And that goes to show you that cash secured puts can be done with small or big accounts. It just depends on the stock you want and your account size. I'd love to buy Costco at $900, so I recently sold a cash secured put for the February 21st expiration, and I collected $925 in premium. If Costco is above $900 at expiration, I get to keep the $925. If it's below and I get assigned, and I get to keep the premium and a price I'd love to own Costco at, which is $900 a share. So it's a win-win for me. 3, what if I change my mind? You can buy back the put before expiration, potentially at a profit or loss. Just note that you might owe more or less depending on the stock's price movement. I recently did this with United Health. I had sold a cash secured put on December 16th for a January 31st expiration, and I collected around $1,200 in premium. I changed my mind in 2 weeks and didn't want to wait until January 31st for the expiration date, right? So on January 2nd, I bought back that put for $677, making a profit of $521, which was the difference in the premium I collected up front and what I paid to get out of that trade. That's the beauty of cash secured puts. You don't have to wait until expiration if you change your mind. Here's one last pro tip used by some legendary traders. It's called the rolling strategy. If you're getting close to expiration and it looks like you're about to be assigned, you can sometimes roll your option, meaning you buy back your put that you sold and then sell another put further out in time, often at a lower strike price or for a higher premium. This can give you even more flexibility if the market's moving against you. But don't get too fancy too soon. Start simple. Master the basics, then explore rolling strategies when you're ready. So that's the big reason why legendary traders do this. By selling cash secured puts, they get into positions on their terms, pocket premium along the way, and set themselves up for success whether the market cooperates or not. If you found this video helpful, don't forget to like it, subscribe to my channel, and let me know down in the comments what stock you're considering to sell a cash secured put on. Also, check out the link in the description below and join my Trading Journey Academy. That's where I post all of my trades when I get in and when I get out, along with other educational resources and a community chat where I answer questions. Now check out this next video where I show you how I make money on trades even when I'm wrong. I'll see you on the next one.